The CEO of Louis Vuitton is the richest person in the world. Why? Because millions of people pay him to look rich while they stay broke. Every single person would rather be rich than broke. But what most people are doing are taking actions which make them look rich, which keep them broke. But if you want to stop playing in this rat race where you're constantly just going to work to get paid so you can pay your bills and you never feel like you're getting ahead financially, and you want to have a bank account that has so much cash that you can buy whatever you want without having to worry about the price, well, you have to start by stop doing these 7 money habits. And money habit number 1 that's keeping so many people poor is that you're blowing your money on the 3 C's: cars, clothes, and credit. If you own a car with a car payment, it might cost you millions of dollars over the course of your investing career. I'll show you. Let's assume that you do nothing crazy. You go out and you buy this $35,000 lopsided car, and in order to purchase this car, you put down a down payment of $8,000. Now, if you go to finance this car over 60 months, well, now that means that your monthly payment to own this car is going to be right around $560 a month. So now what happens is you're going to pay this $560 a month every single month over the course of this loan. Now what you're doing is you're paying interest to finance this car that's losing value, that has a limited time span. It's a triple whammy. So now when this car eventually dies, or you want to get a new car, or what a lot of people do is when you finally finish paying off this car, you go and finance another car and another car and another car. And so people end up paying this interest game on their car forever. Most people never stop having a car payment because you just keep getting a new car. Well, what happens now is when you play this game, you lose out on the opportunity to make millions of dollars that you could have had in your pocket. I'll show you. If you took this $560 a month and you invested this money instead, that's $6,720 a year, and you got the average stock market return, which has been historically 10% a year, and you do this for 40 years, now instead of you owning a car that's worthless, you would own an investment portfolio that's worth just over $3.2 million. Instead, you own a car that needs an oil change. But you want to know what's even crazier? If you kept doing this for a few more years, if you do this for 45 years, from let's just say the age of 21 to 66, well, now instead of having $3.2 million, you would have over $5.3 million in your investment account, because you stayed investing your money. Time is one of the most powerful aspects to you building your wealth. Now you're going to say, Jaspreet, what do you want me to do? You want me to ride a bike 14 miles to work every single day? How am I supposed to do this when I have to have a car? Well, let's take a look at this. You have this car payment, but you also put down this $8,000 down payment, which you could use to go out and buy a car. Maybe not the same BMW that you bought for $35,000, even though you can't really buy that many BMWs for 35 grand. You got to downsize a little bit, but you can get a used, good working condition car for $8,000 today that will take you to and from work safely. And now you can take this money that you were paying to your car company, keep it in your pocket, and use it to build your wealth. It's not as exciting because you don't have the same car, but now you have that wealth which can pay for many cars. Not to mention the fact that most people don't see the same car payment for the next 30 or 40 years. Their car payment goes up every few years because now you go out and buy a nicer car and a nicer car and a nicer car. $560 a month right now. In 5 years, it might be $760 a month. So this amount of money that you can build is actually a whole lot higher, but I wanted to keep it conservative for the purposes of this video. This is why for so many years I've been driving around in a beat down car, even though I make good money, because I've been funneling my money back into stocks, back into buying more real estate, and back into my own business briefs media, because I understand that those things are going to help build me wealth for me, my family in the future, versus my car isn't. And so I wanted to put that focus into my assets before I buy a car. Now, I will be buying a nicer car. I'm not saying you shouldn't buy a nicer car. I want you to be able to afford it first. The second C here, it's clothes. And do you want to know why our society loves it when broke people buy Gucci? Because if Gucci could only sell their products to the people that can afford it, that means only these people right here. If this pie represents people in America, that means only this small slice of Americans who can afford those ugly handbags will be buying it. That's not that many sales. But if they can get people who can't afford their handbags, that means all these people to buy it. That means they can sell a whole lot more stuff, and that's more sales. But that's not all. Banks also love it when you cannot afford the Gucci, because when you want it, they'll be more than happy to sell you the financing to go out and buy that same handbag. You make them rich, but you stay poor. See a trend? Which ties in nicely to the third C, which is credit. Because now if we take a look at the average American household with credit card debt, they have around $6,500 worth of credit card debt today. And if you're paying 27% APR, which is what a lot of credit cards are charging you, That means that if you make the minimum monthly payments of just $150 a month, it might not seem like that big of a deal, but it's going to end up costing you more than $18,000 in interest payments, which means you're going to end up paying more than $25,000 with a small minimum monthly payment to pay off your $6,500 credit card. And unfortunately, most people, when they have this credit card balance, they're not just making the minimum monthly payments and not growing the balance. They're making the minimum monthly payments while also growing their credit card balance, which is why if you want to stop being poor, you want to stop being financially broke, you got to break out of the first bad money habit, which is the cars, the clothes, and the credit. Money habit number 2 is you have to stop working for small increases in your income. Now, you've probably heard me say that it's not how much money you make that matters, it's what you do with the money you make, which is 100% true. Because you can make $30,000 a year, live off of less than what you make, invest some money, and build more wealth than somebody making $500,000 a year who lives off of $600,000 a year thanks to lines of credit and loans and credit cards. So you have to spend less than what you make. But once you understand that part, because in part 1 we talked about how you can spend less, then you have to start working on growing your income. Because now, once you know how to use your money, the more money you have to invest, the wealthier you're going to be able to become. And that means you're going to have to work now to earn some more money. And unfortunately, a lot of people get stuck in this small raise game where people are working for a $2 raise or a 3% raise, a 4% raise, where it can take you a long time to see some significant growth in your income. How long is it going to take you? Think about this, to double your income. If you're making 50 grand a year, how long is it going to take you to get to $100,000 a year? Can you do it in 2 years? 5 years, 10 years. And this is where now, the sooner you can double your income, the sooner you're going to have more money to be able to invest to build your wealth. Now, this is where everybody says, well, Jaspreet, my boss is not going to double my income. And sure, they might not be able to double your income today, but this is where I want you to start thinking a little bit differently and see how you can break out of the mold. If you start wondering how you can double your income, you might start doing things a little bit differently. Maybe there is room in your company to see more excessive growth. Maybe you're in a sales position and you can figure out ways to double your income. Maybe there isn't. And maybe this means you have to look for a new company. Maybe this means you have to look for a new career. Maybe this means you're going to have to go learn a new skill. That way you have the potential to earn more money. But what I can tell you is if you put in a little bit of additional work, this might take a couple of years, it might take a few months, depending on where you are in your career. But if you take some time aside and maybe invest some money in this too, you can learn a new skill set which can give you the tools to get a new career, which can really accelerate your income. And yes, this takes more work. You might have to sacrifice some weekends, some evenings, that way you can learn this new skill, but this can give you the opportunity to maybe double your income. That way you have more money to invest. Because the key here is not to just make more money so you can spend more money. The key is to make more money so you have more money to invest. How can you go by doing this? Well, you can start with YouTube, start learning new skills. But if that's not enough, you can go out and get a certification online that can teach you a new skill that will give you the potential to earn more money. For example, you can check out our sponsor CourseCareers that can help you get a certification to help you land a new career in a new industry. That way you can start making some more money. If you want to learn more about them, I got their link down in the description below. Number 3 is you save money because you're scared to invest. Most traditional Indian households have a save-heavy mindset where you work to make a lot of money just so you can save a lot of money, because investing in money is risky, which it is. You can lose money, which is why I always say, make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But this is where you got to understand investing has risks, but there's also risks with not investing your money. So let's take a look at this from how money has evolved just over the last 5 years to kind of put this in perspective. Between 2019 and 2024, we have seen between 22 to 23% inflation, which means if you want to go out and buy something that cost $100 in 2019, you would need $122 today, actually close to $123, but I'm going to round down to $122 today. That means if you had $1 million sitting under a mattress over the last 5 years, that $1 million would have lost more than 22% of its buying power. It would have lost more than $220,000 worth of buying power just because of inflation. Now you might say, well, Jaspreet, what if I put my money into a high interest savings account? Well, you got to remember, there was no real high interest savings account in 2020, 2021. I mean, they existed, but they weren't paying 4 or 5% like you're seeing in 2024. Back then, you'd be lucky if you got 2% in interest. So let's just assume now that you were ahead of the times and you were able to get a standard 3% return over the last 5 years on your money. Well, that means that your $1 million over the last 5 years would have grown to $1.15 million. Or to keep apples to apples, that would have meant if you had $100 in the high interest savings account earning you 3% a year, which wasn't possible in 2020, 2021, but I'm going to assume that it still was possible. If you were able to get a 3% return throughout those 5 years, your $100 would only grow to around $115. So you still lost value. Versus over those same 5 years, we saw the S&P 500 grow by around 80% during those same 5 years. Which means if you had $100 in the S&P 500, the $100 would have grown to around $180. Is this risky? Absolutely. But the only way for you to beat this inflation is not by saving your money, it's by investing your money. And if you don't have your money in a high interest savings account, well, you're not even getting this. In fact, your money is just sitting there dead, not growing at all. So there is risk with investing your money. The markets could crash tomorrow and you could see the value of this fall. But the reality is, unless you're willing to take some risk, you're never going to see any upside. And the second part of this that you have to understand is that we know markets will crash again. We know that a recession will happen again. This is a fact. Nobody knows when, but the reality is these types of market crashes and recessions create more millionaires than any other time because they give you the opportunity to go out and invest more aggressively. And the way that you can mitigate your risk is by number one, investing for a longer period of time. Number two, understanding financial education, that we know how to find a good investment. That way you don't invest into Sears on its way to bankruptcy. There are a lot of ways to mitigate the risk. For example, investing in an index fund or an ETF, so all of your assets are not in one company. And then number three, understanding the financial trends. If you understand these things and you start investing in financial education and your own financial research, well, then you can get some of the upside without keeping all that downside. The fourth money habit that keeps so many people poor is you work and live for today. It's a very selfish mindset, but I see this all the time on YouTube and Instagram, where I'll talk about how you can invest your money over the long term and build wealth. And one of the very common responses I get is, I don't want to wait until I'm old to enjoy my money. I don't want to have to wait until I'm 65 to be able to enjoy my money. Why would I want to be rich when I'm old when I can spend and enjoy my money today? Well, the reality is time is going to go by, whether you like it or not, whether you're smart with your money or not. And the reality is you're broke today. So now, do you want to have a wealthier tomorrow or just be broke today and be broke tomorrow? Because, people will say things like, well, $1 million when I'm 65 is not going to be that much buying power. So what's the point of me working to have $1 million when I'm 65? Well, at this rate that you're at today, you're going to have $44 when you're 65. $1 million is more than $44. So which one would you rather have? $1 million or 44? And this is where you got to understand, building wealth takes time. It's a fact. There's no kind of golden sauce that you can use to get around that. Building wealth takes effort. You're going to have to put in money. And if you're not willing to put in the effort, and if you're not willing to put in the time, you're never going to see the success. But most people here have a very short-term window that I want to see this richness next month, next year, in 5 years. And if I don't get it, I don't want to put my effort or work towards that because I can't see the light at the end of the tunnel. It's a very selfish way to think because now you're only focusing on today. But if you really want to build wealth, you got to plan for tomorrow, not just today. Number 5 is you make emotional decisions with your money. When people hear that Nvidia is breaking new record highs, what do people do? They don't sit there and say, oh, I wonder if this is a good investment or not. Should I analyze this? No, instead what they say is, oh my God, what if it doubles in value again in 6 months and I'm gonna come in and buy that way I can double my money. It's an emotional investment decision without actually any real financial education applied to it. You see the same thing happen when you see a downturn. People get scared, they start to panic, and then they start to sell. Why? Because you hear the news talking about how everybody is selling, you need to get out now before the world ends. It's scary, and it can be exciting at the top, but this is where if you really want to invest your money and build wealth, you have to know how to do it the right way. I'm glad that you want to invest your money, right? We know that the way you build wealth is by not spending all of your money, taking some of this money and investing it. Now you have to have the financial education of knowing what to invest in. And this is where you have to understand how to separate your emotions from your investments. And this is where I don't want you to pay attention to the news. You should understand the news, but I want you to go even deeper and really understand and pay attention to the trends. You should understand what's happening in the financial markets. As a financially educated investor, as a financially smart investor, you want to pay attention to what's happening, but you don't want to get caught up in the weeds of what's happening day to day and with this sensationalist news. Instead, I want you to understand the trends. Know how money is flowing through the economy. Know the changing in spending habits. Know the changing in patterns that businesses are seeing. That's where you find opportunity. Now, I get it. This can be difficult, especially given that a lot of traditional media companies are always trying to drive clicks, because the more clicks that they can drive onto an article, the more money they make. But there are ways for you to get this type of information. Now, you can go directly to the source where you can read press releases, read what companies are doing, or the second best thing is you can read something like Market Briefs. This is a free newsletter that I created through Briefs Media, where my team is working to break down what's happening in the financial markets. And the reason why I'm so passionate about what we're doing here is because, number one, we make it super simple, but number two, we really try to avoid that emotion, because it's one email. Once you open the email, all the financial news is there. So we don't have to have any of that sensationalism. We break things down that way we can get a better idea of what's happening in the financial markets, and it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. But even if you don't join Market Briefs, you're not gonna hurt my feelings that bad. But what I do want you to understand, no matter what you use to learn of what's happening, you have to be able to separate your emotion from your finances, because that distinction is going to allow you to stay calm when things get crazy. And I can guarantee you that things will get crazy. When? Nobody knows when, but you know things will get crazy. And if you are prepared and you can stay calm, you can find the opportunity and use it as a time to make a lot of wealth pretty quickly. The sixth habit that keeps so many people poor is you refuse to spend any money. And I get the mindset here because I was there before, where if I give you $100, that means you get $100, you get rich, and I have to give you money. But there's a part of this equation that you're completely overlooking, which is, what am I getting in return for this $100 that I'm giving you? Maybe I'm buying a service that's going to make my life a little bit easier. Maybe I'm buying a service that's going to buy me some time back. Maybe I'm buying some education that's going to teach me how I can make $200. And this is where you have to understand the difference between value and price. And I get it, especially when you're first starting to make some money. It can be very hard to differentiate value versus price, because all you want to do is hold on to as many dollars as possible, because you're just looking at your bank account and all you're seeing is, are dollars going out or are dollars coming in? And if dollars are going out, that's bad. If dollars are coming in, that's good. But if you really want to be able to accelerate how many dollars you have in your bank account, you have to figure out how you can bring more dollars in. And sometimes, in order to bring more dollars in, you got to spend more dollars going out. There's a lot of ways to do this. This might be finding ways to buy back your time. I don't edit my videos. I hired an amazing video editor who edits my videos, who buys back my time. I don't manage my own properties. I pay for a property manager every single month. They get paid before I do. But it buys back my time, that way I can go out and find more investment properties to purchase. When I want to go and learn something, I pay somebody. I pay for a class. I pay for a coach. I pay for a consultant who has done something. That way I can learn from their 5 years of experience and knowledge and failures, so I can make less mistakes. Not no mistakes, because I screw up a lot, but you can lower some of that hurdle to learn something if you're willing to pay somebody $100, $1,000, $10,000, $100,000, whatever it might be. But you can lower that curve of learning if you're willing to invest some money and some time to figure out how to do that. And finally, number 7 is you focus on hard work, not smart work. We're all taught that the harder you work, the more successful you're going to be. But unfortunately, that's not how it really works in the real world, especially when it comes to building true wealth. Maybe within your own company, the harder you work, you might be able to see some more success, at least temporarily. But if you really want to see the most growth, the question is, how can you work smarter? That way you can get more things done, be more efficient, and be more innovative. And this is where it's all about smart work. Now, what do I mean by this? Because I'm sure a lot of people talk about you can't just work hard, you have to work smart as well. But this is really where now understanding, how can you use your time and money as leverage to amplify whatever it is that you're doing? For example, I have a Spanish YouTube channel, Minority Mindset en Español, where my videos in English get dubbed into Spanish, and then we publish it on the Spanish channel. Now, before, we used to have somebody that would translate all of my videos. He would have to write down all of my videos, and then you have to go into the booth to record it now in Spanish, and then he'd have to edit this audio, and then he'd have to upload it to my videos and get them on YouTube. So it was a pretty long and hefty and pretty time-intensive process. Now, using artificial intelligence and AI, it takes a fraction of the time at a fraction of the cost. So now, the thing is, where can you work to be smart instead of just working hard? Because if the hardest workers were the highest paid people, you'd have construction workers and teachers as the highest paid people in America, but they're not. And so this is where now the question is, how can you be smarter. Now, one way to do this is by using your money as a tool instead of just making everybody else rich, to use your money to buy investments. That way you can keep getting paid even when you're sleeping, even when you're showering, even when you're on the beach. You can keep getting paid because your money is working instead of just you working. But beyond that, how can you now use your money as a tool to buy back your own time, to be more efficient, and to get more things done? And this might be hiring people, this might be using some technology, this might be using a software, this might be building a team of people that can help you do more things. It's not always easy, but if you can work to be a little bit smarter with how you use your resources, your money and your time, this can give you more resources and have more money coming back into you. Now, before you go, I have a quick request from you. If you got some value out of this video, please hit that thumbs up button. Number 2, subscribe to this channel. And number 3, share this video with somebody who you think will enjoy it. I've spent more than a decade working to build my cash flow portfolio where my stocks pay me every quarter and my real estate pays me every month. Passive income is when you take your active income. This is the money you're making from your job or your business. You have some extra active income laying around, and then you're gonna convert this dead active income that's doing nothing in your bank account to passive income, or we can call it cash flow.